Hey, good evening, everyone. Robert Preston, CEO of Climb Capital. Thank you so much for joining us on tonight's webinar. Obviously, it's a little bit different format than we're used to, so we're pretty excited to try it out. Traditionally, we've done this on Zoom and Google, and now we're switching over to YouTube, and really put a lot more effort, hopefully, in producing a quality webinar for you that is both informative, slightly entertaining, and takes a little bit more of the guesswork of me mumbling along sometimes. So with that, tonight's format going to be slightly different again. There's a section that is pre-recorded. I'm live right now. We're going to transition to that pre-recorded section and then come back to the live Q&A. I'll also bring some up-to-date or some new recent developments to the Campfire Fund and the properties that we'll talk about at the end. And you'll see as we go through the slide deck there that some of the information is not necessarily outdated, but we are providing some updates on the new properties that we're buying and that are under contract and that are in process. And so throughout this time, we'd love to hear your questions and get your feedback. So at any time, just type in that chat box any questions, and then we'll knock those out at the end. Take notes as you go, and we're really excited to share this. So without further ado, I'm going to switch back to the pre-recorded section of here, and we're going to talk through the Campfire Fund, and then again, I look forward to seeing you in about 10 minutes. CEO of Climb Capital. I'm also a husband, father, and big-time RVer. But today, I have the privilege of hosting this webinar. Please give yourself a pat on the back for taking the time to learn about the Campfire Fund, and thank you for choosing Climb Capital. At this point, you may or may not know if you're ready to invest in RV parks, but if you're here, you're at least curious about the opportunity. By the end of today's webinar, you'll have a solid understanding of the emerging opportunity and how you can choose to be part of it. Here's the disclaimers. I'm not an attorney and I'm not a CPA. However, I've spent almost a year traveling the U.S. in my RV. I own and manage 9 RV parks, and on the last RV park that we sold, we tripled that investment. So if you have an RV park question, ask me. But if you have legal questions or want to avoid the IRS, ask your attorney and CPAs. This is an investment. This is not a loan. There are no guarantees, and projections and figures are estimated based on the market data and our experience. The Campfire Fund is an SEC-registered Reg D 506C real estate investment fund with a total capitalization of $20 million. The fund is buying RV parks across the Sun Belt of the U.S. We use leverage to purchase 65 to 75 million in RV park assets. There are 2 investment classes that you will choose from. Our B1 yield class has a projected 11% cash flow, and our B2 equity class has a projected 15 to 20% IRR. When stabilized, distributions will be paid out quarterly on a quarterly basis. Investors will participate in tax shelter strategies, and there is a 2% acquisition and 2% asset management fee paid to the sponsors. The status quo for real estate investing has become stagnant, but that's changing, and I'm excited for this new opportunity. You're probably familiar with this strategy. Buy an apartment complex, do some perception upgrades, raise the rents, reduce the expenses, refinance, and repeat. Or maybe you've heard this one. Buy a commercial property with triple net leases and never lift a finger again. Both make sense. People have to have a place to live, and triple net tenants pay all your expenses. But here's the problem. Just about everyone knows this. And with all the competition, prices have gone up, margins have gone down, and finding a great deal on an apartment complex or commercial real estate is like finding a needle in a haystack. Now, add the rising interest rates, and you've got that proverbial needle that broke the camel's back, or something like that. RV parks themselves are no short-term fad or bump in the road, pun intended. The RV Industry Association, or RVIA, says that last year, the RV industry was responsible for $140 billion of economic impact to the U.S. In the past, passive investments in RV parks simply didn't exist, and even today, funds like the Campfire Fund are relatively rare. This means, relative to other commercial real estate investments, the competition is currently limited, and we can regularly find great deals, and since there are still sizable margins on these deals, we are generally unaffected by rising interest rates. Right now, there is a real opportunity to invest in RV parks before competitors flood the market, but that window is quickly closing. That's why we believe in this fund, and we strongly urge you to consider it as well. Why RV parks? Well, first, they have a diverse customer base. RVIA says that there are 11.2 million RV owners. Of those 11.2, half are above the age of 55, and obviously the other half are below the age of 55. Interesting enough though, it's not the baby boomers that are growing fastest, but the younger generation, with 22% of the market falling in the 18 to 34-year-old range. Secondly, they're recession ready. Let's address what most of you are actually really here to find out. You're wondering, how safe is this investment? What happens to RV parks in a recession? And aren't these a luxury item? Here are some interesting facts. During the 08-09 Great Recession, sales of RVs plummeted down 60%. From their peak in 2006, it took retailers almost 10 years to recover back to that same unit sales mark in 2006. During that same time though, KOA, RVIC, and the national parks all reported either equal or a slight increase in occupancy of those parks from 2008 and 2010. In fact, if we look at the early 1980s recession and the 2000 recession, we see the exact same trends. The sales of RVs plummet, however their usage and occupancy of the parks themselves stay essentially the same. I argue and predict that this recession will have little to no effect on our occupancy and that rates will actually increase, and here's a few reasons why. First, RV sales have skyrocketed leading up to this year, 2023, meaning there are more RVs in the driveways of our customers. If you couple this with the proliferation of RV sharing websites like Outdoorsy.com and RVshare.com, that means that more people can afford to own the RVs, and then those RVs are being used by the owners and the renters, meaning more nights sold at our RV parks. Interesting enough, last year, one of the top complaints by RVers was the unavailability of sites to book at parks and their overcrowding. Baby boomers add to the retired demographic at a rate of 10,000 people per day. Millennials have proven to be huge fans of RVs and outdoor activities. Remote work, housing unaffordability, traveling professionals all support a strong foundation of long-term RV customer demand. Vacationing via RV is approximately half the cost of a comparable hotel-based vacation, and data shows that most people still go on vacation during recessions. They just choose more economic trips. Industry fragmentation. Remember back in the early 1990s when you started hearing about mini storage and you started seeing all these long metal buildings with hundreds of doors on them? Well, at that time, there was very little information available, and most of the owners were mom and pop investors looking to make use of vacant land. CoStar didn't have any great data, brokers weren't specializing in them. In general, there wasn't much sophistication. But look at their proliferation and success now. As I see it, RV parks are a lot like mini storage or even apartments, in that they're following the same predictable industry progression, making them the next booming asset class. Versatile revenue streams. As an RVing family, Misty and I often load up the 4 kids, 2 dogs, and what feels like a year's worth of supplies, just in case. And then we head out. On one of our very first trips, we stopped at a great campground seated beside a beautiful lake. And of course, the kids wanted to go fishing. And of course, in our extensive packing of supplies, we had forgot the fishing poles. Convenient enough, the campground sold fishing poles and crickets as bait, of course. And then they sold us more crickets when the kids left the cap off the cricket cup. And of course, they sold us some ice cream that the kids saw while we were buying said fishing poles and bait. And after a great day of fishing, Misty and I wanted to enjoy a relaxing campfire on our folding chairs. And by now, it's probably no surprise that we had also forgotten the firewood. But don't worry, as luck would have it, the RV park also sold firewood. In fact, they would deliver it to our site. And by the end of the trip, we had spent almost double what our original bill was intended to be on extras. And you know what? We were happy to pay it because you can sell and put a price on firewood, fishing poles, bait, ice cream, but at the end of the day, you can't put a price on quality family time. Exit flexibility. When you own a single asset, you're limited in the ways you sell a property, and you're limited in who you could actually sell that property to. As a fund, the Campfire Fund will be a lucrative target to an institutional buyer, and we can expect to see a premium for a well-curated and managed portfolio. Most of the parks that we buy fit in a typical buy box. They're located in warmer climates for year-round operations and close to interstates for ease of access and increased customer demand. and generally have some type of water feature. This allows us to implement a predictable and phased asset management approach. First, we do cosmetic and perception upgrades. These upgrades can actually be fairly extensive in the form of new pools or clubhouses, or could be quite as simple as landscaping and new signage. Secondly, but generally simultaneously, we optimize the management and operations of the RV park. More often than not, the previous owners have neglected the power of social media, websites, online booking, and reservation management systems. One of the easiest things we can do is simply put the park's cabins on Airbnb. And instead of forcing customers to find the rentals on an obscure website, or even worse, to have to call in the book, Airbnb and VRBO exposes our cabins to millions instantly. In fact, it's not uncommon for us to increase the park's revenue by 20% the first day of ownership, simply by changing the daily rate and implementing dynamic pricing. And here's a stat that I'm really proud of. Our property management team has averaged a 67% increase in our year one revenue over the previous owner's revenue. Thirdly, many of our properties come with acres of unused land that is prime for expansion and development. Because we are expanding an already existing park, entitlements are easier to obtain and return on investment goes up. The clubhouses are already built, the pools are already built, and the major infrastructure is in place. The construction cost of adding those additional sites goes straight to the bottom line. Of course, all of our exit options still exist at the single park level. We can sell that park, we can refinance that park, or we can again couple this park with multiple other parks and sell and refinance the park as a portfolio. Some of you may have heard our story, but we started out with mobile home parks and Class C apartments. Over the years, we have hired and fired many property management companies. And through our frustrations of dealing with their incompetence and apathy, we came to the realization that we had to bring management in-house, and thus Altitude Property Management was born. Because we're the owners and operators, our philosophy is a little bit different. Resume and experience, as important as they may be, are not great indicators of success. We found that a better indicator is character and drive. We craft our hiring process around finding our next partners, not our next employee. That decision has set us apart from our competitors and has proven to be very successful. Here's a quick glance at our current portfolio. Parks in black are parks that were owned before this fund existed. Parks in blue are owned by this fund, and parks in green are parks that will be added to this fund in the near future. It may be cliche, but the strength of a business is its people. Building off of our management and hiring philosophy, Climb is composed of driven entrepreneurs with character forged in mostly military aviation. So to recap, the Campfire Fund is a $20 million fund that will purchase and operate 10 to 20 parks across the Sun Belt of the U.S. The fund will be managed by myself and the Climb Capital team. We bring the operational excellence and experience needed to run this fund. RV parks have proven to be dependable investments over time, but as the RV market begins to consolidate, that window of maximum opportunity is quickly closing. There are two ways for you to be part of this opportunity before it's too late. Our Campfire Fund's preferred equity yield class with 11% preferred return, and our B2 class with a 7% preferred return and then 60% equity of the entire fund. Most investors choose to do more, but the minimum for either class is just $50,000. Investors must be accredited and may use retirement accounts, trust, corporations, and personal funds to invest. If you fit this criteria, you are eligible to invest in the Campfire Fund. But since we are a relationship-based company, we want to make sure that we are a good fit for each other. Here's what you need to do to take the next step towards being part of the fund. Simply reach out to us, express your interest, and if we haven't met yet, we'll schedule a quick meeting and make ourselves available for any specific questions you may have. Then we will give you online access to our investment portal where you'll be able to execute and view your investments. Investments spots are first come and are limited. The big opportunities in RV parks are right now. Contact us, get started, and thank you for your interest. Okay, thank you guys for listening through that section. I wanted to first start with a few update points. So first, on the graphic there on the map, you guys saw that in green, those were our pipeline deals. And one of those was Owl's Roost Campground up in Nashville. We actually had the pleasure of closing that last Monday, just a little bit over a week ago. So that one is under contract, or sorry, that one is closed. That is part of the fund. And then the second one up there on the graphic was a little green emblem out in Page, Arizona, right next to Antelope Canyon and Horseshoe Bend, which are some super popular destination sites. So that one is scheduled to close actually this Thursday. So hopefully in a couple days I'll be signing the documents tomorrow, and then closing on that on Thursday. So that'll be in the fund. And then what wasn't depicted on there, which we're super excited about, is our fifth property that will be going into the fund, and that's currently called Johnny's Lakeside RV Resort, which is in Foley, Alabama, just about an hour away from here. 200 sites, lazy river, water slides, restaurant, venue, and you saw a lot of the B-roll there. That was at Johnny's actually of there. So that's going to be a great park. We were buying it at a really strong price and super excited. Plus it's like an hour away, so I can take the kids and we go to lazy river and hang out there. So those are some property updates. That'll be the fifth property. That's scheduled to close mid-June timeframe for us. And then on the investment side, our B1 class is actually fully funded. So we are happy that they were presented there. That went relatively quick with our investors. And then the vast majority of the fund now is on the B2 side. So that is still open. So I'm going to, if you guys have any questions, feel free to type those in. If not, we'll end this again with a contact us. And so again, to kind of reiterate, the next step's very simple. Just shoot us an email, use the QR code, anything along those lines that said, hey, I'm interested in the Campfire Fund. And if you have further questions or want to set up a one-on-one call, we'll do that. Otherwise, you can just simply set us up there. We'll give you the online portal access. You'll review the documents, the legal documents, and then we move on from there. So, okay, so I usually get one question that we did not cover in detail on, and that goes along with depreciation. So with the depreciation side of that, most of the time we do cost segregation studies, which still apply to RV parks, and they still give us significant accelerated depreciation benefits there. So we do those. Those are passed through in the form of K1s to you, the investor. I get that a lot. Some question on specificity, or what is the difference between B1 and B2? So B1 is the investment class that had a 11% preferred return. So that was top of the capital stack. And so those investors receive the first 11% in the cash flow distributions. And then everything above that then is moved over to the B2 investor. The B2 investor then receives the next 7% plus 60% of everything on top of that 7%. So the B1 is a great option. That is preferred there, but really has limited returns at the 11% mark. The B2 side of it, again, we project to be the 15 to 20% IRR. Got a question about when do investment starts. So we're raising capital, actively filling the fund with the properties. Like I said, we'll be at our fifth property in June, continuing to add those, and we'll continue to fill those properties out until the capital is deployed, which right now we're close to an 80% utilization rate in the capital raised versus capital deployed. Having said that, it will likely be the end of this year and or early quarter one of 2024 before we start making those distributions. Again, to set expectations, those distributions will go first to the B1 investment class. Those will be paid out first, and then as it flows down there too. So your B2 class, again, to set proper expectations, I would expect those will be later on in 2024 before those quarterly distributions begin. Now, both classes obviously accrue that preferred return during the purchase period time. So throughout your investment, preferred return will be based off the date that you invest and then when the capital is received. So hopefully that answers your question. Okay, so those are great questions. I'll leave it open for about 30. Yeah, again, minimum investment is $50,000 for either class. Both classes have exactly the same paperwork, same investment criteria. The accreditation is a very simple process. We don't verify that. You don't have to submit us any documents. The only thing that we ask you to do is provide a letter from your CPA, financial accountant, or there's some online services that simply says you are accredited. For us, that's a yes or no question that we upload into your file. So we're not going to actually verify or dig into the numbers, but must be accredited, and $50,000 is the minimum on that. So there's a question on the length of the fund. When does it end, or how does it end? Is probably a better way to look at that. Again, so this is technically an open fund, meaning there is no mandate to sell the properties, and that would be a bad thing. If there is a mandate, we would potentially be forced to sell our properties in an inopportune market environment and cause losses. However, I will tell you our objective is that we underwrite and look at almost all deals at the 5-year mark. And so your expectation for capital into this fund should be a 5-year commitment. At that point, in prior to 5 years, of course, there'll be certain properties that we sell for profit. Those, when that happens, that'll be a capital event, or we refinance. Again, a capital event, and either one of those capital events past the 3-year mark of the fund, those earnings and the original principal will be returned to you as return of investment beginning at the 3-year mark. Prior to 3 years, we may use those profits on properties that are liquidated or refinanced to reinvest to buy more properties. So after the 3-year mark, again, once there's a capital event, we'll start to return of capital. At the 5-year mark, we anticipate our ability to be able to return all of your initial investment, whether that means we still may own some properties in the fund perpetually past the 5-year mark, but within that time period, we should be either liquidating the entire portfolio or liquidating single assets or refinancing the difference to return that initial capital. So hopefully that answers your question. I would think about this as a 5-year commitment. So great questions. Again, I will leave it for just a couple of minutes, but this webinar will be recorded. Obviously, part of it's already recorded, so we're going to record the Q&A part of it as well. We'll make that available to you tomorrow. Since you registered, you'll get an email with this link to there. And of course, I'm happy to always set up a meeting with myself or anyone else in the team to kind of dig into specific scenarios, specific situations to you. We can't specific situations to what your scenario may be in utilizing cash or IRAs or solo 401ks, et cetera. There's all ways that we can utilize those in this investment fund. So with that, really appreciate your time tonight. I'm going to sign off, and we thank you.